Today, we're diving deep into mind blowing revelations about the central bank's gold acquisitions that will leave you speechless, especially when we uncover Jim Rickards' insights. Imagine a jaw dropping 400 tons of gold purchased in a single quarter. A feat unparalleled since the 1980s. But that is not all. Lesser known players like Russia and China are making waves with their gold buying sprees, stealing the limelight. We'll unravel the mysteries behind their extraordinary acquisitions and evaluate the potential implications of this unprecedented development. Get ready to be amazed as we delve into the fascinating world of central banks and gold. At InvestWise, our mission is to arm you with the crucial investment expertise to flourish amid market volatility. Hence, accompany us on this eye-opening expedition by hitting that like and subscribe button for the freshest financial news and perspectives. While Russia's strategy remains fairly open, China's has grown increasingly enigmatic. Furthermore, we'll reveal how 2010 signified a pivotal moment when central banks transitioned from net sellers to net buyers after a 40-year period. And just wait until you learn about Switzerland's dwindling gold reserves. It's a tale that will leave you perplexed. Let's dive in and expose the secrets of central banks' gold acquisitions in the context of Jim Rickards' analysis. Recent trends in the gold market are particularly relevant in light of Rickards' views. The United States has seen a decline in its gold reserves since the 1950s, with central banks becoming net buyers in 2010. While not every central bank worldwide is purchasing gold, the significantly reduced sales volumes suggest that other players are filling the gap. China has emerged as a major buyer, with countries such as Mexico, Kazakhstan, the Philippines, and Vietnam reportedly purchasing gold from China, while Russia remains a significant and steady buyer. Despite these trends, there are notable exceptions. Americans seem to be losing interest in gold, while people in Canada and other countries hold differing opinions. However, central banks continue to see the value in gold as a reserve asset, with recent developments highlighting its importance. For example, Turkey is buying large quantities of gold, while Japan, with its long history of holding substantial gold reserves, managed to double its stockpile from 600 to 900 tons in just a month, transparently reporting its actions in its financials. The conflict in Ukraine is another factor contributing to supply-side inflation. The tensions between the US and Russia have led to supply chain breakdowns, causing energy supplies to dwindle due to the high oil prices, among other issues. While the Federal Reserve cannot make oil, wheat, or semiconductors, it can protect against inflation and economic uncertainty by increasing its gold reserves. The Fed can watch demand, but can't control rising costs or oil prices. It's tough to argue that if the supply issue lasts long enough, people's mindsets will shift, and we'll see demand pull inflation. They're trying to control the ever-growing demand because they can't fix the supply side, but markets and investors aren't ready for this. They think inflation will start dropping soon, but no one's preparing for the possible deflation or a severe US recession in 2023. Everyone's scared of a recession, but things might get way worse than expected, and then the printing press will stop once more. It has been said that QE, or quantitative easing, which amounts to $9 trillion, didn't really have a positive impact. The Fed employs QE by assisting bond buyers in obtaining bank loans, but banks merely act as intermediaries and return the money to the Federal Reserve. In reality, it doesn't appear to benefit the economy at all. The global financial landscape is experiencing significant shifts, with various countries exploring alternatives to the US dollar as the primary reserve and payment currency. As preparations are made for a future where the dollar may no longer hold the same status, countries such as BRICS, the Shanghai Corporation, OPEC Plus, and China are developing new payment systems. The potential implications of these developments for the way people shop are vast and varied. Another significant trend in the financial world is the massive gold purchases being made by central banks. This year alone, a record-breaking 400 tons of gold were bought in the third quarter, a level not seen since the 1980s. China and Russia are known major buyers, with lesser-known buyers such as Mexico, Kazakhstan, the Philippines, Vietnam, and even Iran entering the game. In 2010, central banks shifted from being net sellers to net buyers, with Switzerland's value suffering and the US losing thousands of tons of gold. Despite Americans losing interest in gold, central banks worldwide continue to view it as a valuable reserve asset. These developments align with Jim Rickards' views on the importance of gold in the global financial system. Rickards, an American lawyer, economist, and author, has long been an advocate of gold as a store of value and a hedge against economic uncertainty. His belief in the need for a new international monetary system that includes gold as a component has been influential in shaping conversations around gold's role in the global economy. The recent trends in the gold market and the growing interest in alternative payment systems highlight the relevance in Rickards' views. As the dollar's status as the primary reserve currency is challenged, the value of gold as a store of value is being reinforced. Gold remains an attractive alternative for central banks worldwide, particularly in light of rising inflation and economic uncertainty. Rickard's advocacy of gold's importance in times of economic turbulence is reflected in the growing interest in gold as a reserve asset. Inflation is a complex issue that causes prices to rise and weakens currency. It has two primary drawbacks. One is called cost push, which occurs when there is a shortage of something like oil and tensions between the US and Russia continue to escalate. This conflict is disrupting supply chains, leading to reduced energy supplies due to the high oil prices, and so on. Thus, it is a supply issue. Another type of inflation, called demand pull inflation, is less visible but still problematic. It happens when people start thinking, I was planning to buy a fridge in 6 months, but the prices are rising so quickly, it's better to get it now. In the 1970s, both types of inflation were troublesome. The situation started with cost push because of an Arab oil embargo, but by the late 1970s, spending spiraled out of control. Currently, supply side factors are pushing inflation up, with fuel being a vital part of our daily lives, and the price keeps going up because we need transportation for all of our goods. This price hike affects the pricing of everything else. Producers and sellers are also dealing with extra costs, limits, and shortages. Unfortunately, the Federal Reserve can't do much about supply chain problems since they can't create oil, wheat, or semiconductors. The situation has gotten worse because of the conflict in Ukraine. While the Federal Reserve is keeping an eye on demand, they can't control rising costs or oil prices. And if supply issues keeps going, eventually people might start buying more because they're worried about future price increases. The Federal Reserve is trying to control this growing demand since they can't do anything about supply. However, markets and investors aren't ready for what's coming. They expect inflation to drop soon, but they haven't planned for deflation or a bad recession in the US in 2023. Everyone is scared of a recession, but things could get even worse than we think, and then the money printing might stop again. When it comes to the issue of quantitative easing, QE, totaling $9 trillion, it hasn't really helped. The Federal Reserve uses QE by helping bond buyers to get bank loans, but banks just act as middlemen and then send the money back to the Federal Reserve. This doesn't do much for the economy. Keeping interest rates at zero doesn't make sense either. The Federal Reserve is getting ready for a future where the dollar slowly stops being the main reserve and payment currency. Even things like baseball cards and bottle caps could be considered currency if people accept them. Countries including those in BRICS, the Shanghai Corporation, OPEC Plus, and China are working on new payment systems that could completely change how we shop. It's important to consider that the future of currency is constantly changing, and the global financial system is evolving with it. The Federal Reserve plays a critical role in managing the U.S. economy and has been working to control inflation by adjusting interest rates and printing more money. However, these efforts are not always effective, and there is a growing concern among investors and markets that a recession could be looming. While inflation is a complex issue, it is clear that supply chain problems are driving prices up, and the Federal Reserve is struggling to keep up. Quantitative easing and keeping interest rates at zero have not had the desired impact, and there is a growing concern that a recession could be on the horizon. The future of currency is also rapidly changing, with new payment systems and currencies emerging that could completely alter the way that we shop and do business. It is vital that investors and markets stay informed and prepare for the challenges that lie ahead. Loved this video? Subscribe, like, and watch this one too. Thanks for watching.